If you're self-employed or you run a small business, you know exactly how much work it took to build up your SEP IRA. Seriously, congratulations on that. But saving the money, that was only half the battle. Now we've got to talk about how to spend it, and spend it smart.
So that's the big question, right? You've built this amazing nest egg, but getting the money out isn't just like going to an ATM. The real trick is turning that account balance into a steady, reliable paycheck for yourself without handing a huge slice of it right back to Uncle Sam. So let's dive into exactly how to pull that off.
Here's our game plan for today. We're going to start with the absolute basics. Then we'll get into the nitty-gritty of taxes and those pesky penalties. After that, the fun part, 5 really smart strategies you can use. We'll also cover some key exceptions to the rules and then wrap up with the big mistakes you definitely want to sidestep. Okay, first things first, let's build a solid foundation. Before we can even talk about withdrawal strategies, you have to know the rules of the road. And when it comes to your SEP IRA, there are a few key ages that are like major milestones, each one unlocking new possibilities or new rules you have to follow. Think of these 3 numbers as your retirement guideposts. 59.5, that's the magic number when the door swings open for penalty-free withdrawals. Then you have 70.5, when a really powerful tax-smart tool for charitable giving opens up. And finally, age 73. That's when the government steps in and says, okay, time to start taking some of that money out, whether you need it or not. Burning these 3 ages into your brain is step 1 of a brilliant withdrawal plan. All right, we've got the timeline down. Now let's talk about what really matters, the money. Every dollar you take out has potential costs attached, and understanding these is absolutely key to keeping more of your hard-earned savings in your pocket. So here's the number one thing you have to remember. Every single dollar you pull from your SEP IRA is taxed just like it's a paycheck. It's ordinary income. This is so important because if you take out a huge chunk all at once, say for a big vacation or a new car, you could accidentally launch yourself into a much higher tax bracket for the year. And that would be a really painful and expensive surprise. And as if paying income tax wasn't enough, there's this number, 10%. This is the big penalty everyone wants to avoid. If you touch that money before you hit that magic age of 59.5, the IRS typically tacks on this extra 10% penalty. It's a really high price for getting your own money a little early. And last but not least, let's not forget about those RMDs, or required minimum distributions. Once you turn 73, you must start taking withdrawals. If you forget or just miss the deadline, there's a steep penalty. It used to be an insane 50%, but now it's a still very painful 25% tax on the amount you were supposed to take out. It's a totally avoidable mistake, but a costly one if you mess up. Okay, enough of the scary stuff, the taxes, the penalties. Now we get to the good part, the strategies. Think of this as your personal playbook, full of powerful moves you can make to take control and generate that tax-efficient income you've been dreaming about. First up is a special one for all you early retirees out there. It's called a 72T plan or a SEP. Basically, it lets you set up your own personal pension. You can take out fixed equal payments before you're 59.5, and you get to dodge that 10% penalty. The pro is obvious, penalty-free income. But, and this is a huge but, the con is that it is super inflexible. Once you start, you are locked into that payment schedule for years. It's for people who need the income and are 100% sure they can stick to the plan. Now this strategy, this is where things get really clever. It's the Roth conversion. Here's the play. You strategically move money from your SEP IRA over to a Roth IRA. Now, the catch is you have to pay the income taxes on that money right now in the year you convert it. But this is genius for people in that golden window. You know, those years after you retire, but before Social Security and RMDs kick in and drive your income up. You're basically paying taxes at a discount now to create a bucket of money that's completely tax-free later. If you're someone who likes to give back, you are going to love this one. Starting at age 70.5, you can make a donation directly from your IRA to a qualified charity. This is the ultimate win-win. Why? Because that donation can satisfy your required minimum distribution for the year. But, and here's the magic part, the money never counts as taxable income for you. It's just a fantastic way to support causes you believe in while also managing your tax situation. All right, strategy number 4 isn't some complex tax maneuver. It's more like financial spring cleaning. If you've got a SEP IRA here, an old 401k there, it can be a real headache. By rolling your SEP IRA funds into a single traditional IRA, you just make your life so much easier. You get one statement, one set of investments to manage, and, most importantly, one simple RMD calculation. Never underestimate the power of simplicity. And our final strategy is all about one thing: peace of mind. You can use a piece of your SEP IRA to buy something called an annuity, which then turns around and pays you a guaranteed stream of income, often for the rest of your life. This is perfect for retirees who just want to know without a shadow of a doubt that their essential bills, the mortgage, the lights, the groceries, are covered every single month. It creates a solid income floor you can count on, and that helps you sleep at night. So remember that scary 10% early withdrawal penalty we talked about? Well, it's not always set in stone. The IRS actually has a few get-out-of-jail-free cards you can use in certain situations. Let's run through the most common ones real quick.
We already talked about the 72T plan for early retirement income. But you might also be able to dodge the penalty if you're paying for qualified college costs or for a first-time home purchase, though there is a lifetime cap on that one. And this is a big one. If you have major medical bills that are over a certain chunk of your income, that could be an exception too. The main thing to remember is that the rules for each of these are super specific, so you've got to double-check that you qualify before you make a move.
All right, we have covered the rules, we've covered the strategies. To bring it all home, let's talk about the 4 big financial fouls. Seriously, avoiding these pitfalls is just as crucial as picking the right strategy in the first place. First up, the impulse withdrawal. Just taking money out before age 59.5 on a whim, without a plan, and without checking to see if you qualify for an exception. Well, it's basically like volunteering to pay extra taxes. That 10% penalty, on top of your regular income tax, can take a massive bite out of your savings. Mistake number 2 is all about timing your RMDs. Forgetting to take one is bad enough, but a lot of people mess up their very first one. You see, you have until April 1st of the year after you turn 73 to take it, but if you wait that long, you'll end up having to take 2 RMDs in that single year, which could create a real tax nightmare. Oh, this is a sneaky one that blindsides so many retirees. It's called IRMAA. A single large withdrawal from your IRA can boost your income so much that it triggers this surcharge on your Medicare premiums. And the really nasty part? They base it on your tax return from 2 years prior, so you get this surprise bill for higher premiums long after you've already spent the money. And here we are, full circle, back to our old friend, simplicity. Leaving a bunch of old SEP IRAs scattered around at different companies is just asking for trouble. It makes calculating your total RMD a complicated mess, and it dramatically increases the odds that you'll make a costly error. Do yourself a favor and consolidate. So, if there's one thing you take away from all of this, let it be this: saving money for retirement with just step 1. Step 2, the part that's every bit as important, is building a thoughtful, tax-efficient plan to actually spend that money and turn it into the retirement you've worked so hard for. And that leaves us with the final, most important question of all. Looking at these tools, creating an income stream, converting to a Roth, giving to charity, it's not about finding the one best strategy. The real art is asking yourself, which combination of these strategies is the perfect fit for my life, for my goals? Getting that answer right, that's the key to a truly secure financial future.